Good morning, this is Meir Valensky with Driving Markets. So overall, yesterday the markets ended up flat. In the morning they were down, in the afternoon they were up, and towards the closing session they were higher. However, in the last hour of trading in the States, the market sold off again, simply because investors don't want to take the risk in light of corporate earnings that may come in worrying or may be concerning to the markets, and therefore they pulled out of shares, stocks, investments, and the markets went down as a result. One of the particular shares I want to look at before going into the broader overall view of what's happening is Facebook. So Facebook last night came out with some interesting figures. I'm not a big fan of Facebook because I simply don't like Mark Zuckerberg. So anything I say regarding Facebook always has a slight negative slant to it, so take that into account when I'm commenting. But let's try and be objective here. So Facebook's earnings came in slightly less than expected by analyst expectations. That wasn't such big news. The earnings per share also came in a bit less than what was expected. That also wasn't major news. What was major news is that they'd stopped the hemorrhaging of users. In other words, they added more users to Facebook in the last quarter, and that gave a bit of confidence to investors and to the market. In addition to that, they also said, in conjunction with the fact that users have been added, they're cutting costs. Their cost expectations were around about 95 billion in the next quarter, and it's probably going to forecast is down to around about 83 to 85 billion, and that pleased the markets, and as a result the shares after hours went up 13%. Overall, my view is, and remember, I am slightly negative on Facebook, I think the shares are going to go down. I don't think they're going to hold at these levels because I just can't see them building up the revenue that they need, especially in light of the concerns regarding rates, inflation, and maybe going into recession. So take that into account when you're trading on Facebook, if you are a follower and if you hold those particular shares. And let's take an overall view now of where we're at. So the interesting point came up. I started looking at the benchmark European bonds, which is the French bond and obviously the German Bundesbond. And they've been flat for many years, like all other bonds. However, they've begun to creep up to the highest they've been in 12 years. So you've got the German Bundesbond running at around about 0.83 yield, and you've got the French bond running at about 1.31, 1.32. Remember, all these rates were flat in the last 10 to 12 years, and suddenly they've spiked up. So obviously there's the bonds around the world have moved up. However, look at the French and the German bond. Why do I focus on that specifically? Because Christine Lagarde, the head of the European Commission, the ECB, has said specifically that she's not going to raise interest rates. Now, if she's not going to raise interest rates in the EC, then it doesn't make sense. Because why would the bonds rise? So the bonds may rise for flight to safety. However, the flight to safety should be on the US Treasuries, not on the European. So the investors in the markets are pricing in a rate rise by the ECB within the next 3 months, which contradicts what Christine Lagarde said, and therefore there is likely to be a rate rise in Europe. The other question I was asked also by a viewer is to focus a bit more on the dollar. Okay, so the dollar has two aspects to it. Number one, the dollar's strength has been based on speculation of an increase in interest rates, and there could be a 75 basis points increase next week by the Fed. I know it's an unlikely prospect. However, it is on there, and it could happen because Jerome Powell and the Fed members are getting really concerned about inflation, which is running riot. The other factor that's pushing up the dollar strength is you've got the flight to safety. So what actually happens is that when investors are concerned, then what they'll do is they'll dump riskier investments and they'll turn to things that are more solid, which would be typically something like the US dollar. Sorry, I was just checking in the mirror there. Something like the US dollar. The US dollar is a flight to safety, and therefore by being a flight to safety, it's going to cause demand to rise, which is also pushing up the dollar. The dollar is high against a basket of currencies, and I would say against most currencies. I haven't to check the exotics, but it's definitely higher against the majors and some of the minors. Just to be aware of, it is really, really pushing higher, and likely to go much higher in the near future, as long as these comments by the Fed and the fears of inflation are rising. I also want to mention something about cryptos. Now, Bitcoin has been bouncing around the 37.5 to 40,000 level. I do think Bitcoin is on the way down to about 32,000 level. Please pay attention to it. I think it's probably going to drop to about 32 and a half, and from there bounce back up again. Just to keep an eye again on Bitcoin. It looks vulnerable at these levels, and I see that it's building up a downward trend, downward pattern. So you might want to look to either go short of Bitcoin, or if you're not in there, wait for it to drop to those levels. Also look at Tesla. Tesla around about the 720, 750 level looks like a solid buy. It has come off a lot on the back of concerns regarding the financing for the deal on Twitter, so that's also something you should keep an eye on. Regarding the semiconductors have come down significantly in the last few days, as investors again are running away and escaping from any high risk investments and moved away from the semiconductors, and they're also on a trend southwards. However, the volatility is there, and there's no absolute clear short-term direction to the market, but I do say continuously, by the end of this year, the Nasdaq will be at 7,000 and the Dow will be at 18,000. That's my opinion. I'm sticking to it. That's where I see we're going, and I see interest rates at 5% and inflation officially be in excess of 10, 11%, unofficially 20, 25%. That's my view on Mayor Volensky driving markets. You can contact me on LinkedIn, WhatsApp, YouTube, Instagram, Twitter, whatever other social platform I might join. Good talking to you. Please like, please subscribe. Speak to you soon.